All right, welcome everyone to the next of the series webinar we host at p2p.org. And I'm excited to have some amazing guests today. My name is Max Mironov. I'm General Manager of New Bets of P2P, primarily working on the data products. And today we are going to talk about the trading infrastructure on-chain. So institutional participation in digital assets is clearly accelerating, but there are different sorts of participation, and that's only part of the story. So there is latency, data quality, execution reliability, and overall market structure. All that will decide whether on-chain venues will actually carry professional trading volume or not. So yeah, this is what the conversation today is about. And without further ado, let's probably start with a quick introductions. So we have some amazing guests today. Please probably share a few words about yourself, your company, what your company does. And then if there was any particular headline or like an interesting conversation you had over the last couple of weeks, which indicates where we are right now in terms of institutional trading adoption, feel free to share as well. Anybody wants to start? Okay, let me do this. All right, it's all right. Duncan, let's probably start with you.
I was going to go anyway. Well, look, thanks for having me, Max. My name's Duncan. I'm president at 21 Shares. So we're Europe's largest crypto asset management company, founded in 2018. We've got about $6.5 billion at the firm across Europe, the US, Australia, and Brazil. And we started as an ETF and ETP issuer. I think we've done about 60 products or so in the market now today. And I guess really pioneered the space, first spot Bitcoin product, first staking product, etc. I don't know any interesting anecdotes. I guess the one thing that's probably relevant for this conversation is more and more we're hearing from clients asking how they can get exposure through regulated vehicles to DeFi, and that's picking up both in Europe and the US.
Awesome, Duncan. Thanks for the introductions. Looking forward for more anecdotes. Alexander, let's continue with you.
Yeah, absolutely. My name is Alexander. I'm the co-founder and chief product and risk officer at Arkis. Arkis is a crypto prime broker. We actually serve a wide range of clients and a wide range of venues, including centralized venues, traditional finance venues. So we provide DMA, credit, OTC solutions to our clients, and also on-chain venues, of course. Those people who've been, for a while in the industry know that we actually were initially a DeFi prime broker. So we actually started from on-chain natively and naturally progressed into centralized exchanges, prime brokerage, and traditional finance prime brokerage, because we see that you cannot take a look at those areas in silo, but they actually converge. So regarding the anecdotes, I would say that it is misconception that crypto only is not institutional. Even like 3-4 years ago, most of the Aave trading and Uniswap trading was actually done by institutions or regulated entities. So yeah, I would say that institutions have been always driving crypto, like crypto volumes mostly, but now it becomes obvious, and I agree with Duncan that we see more and more requirements for facing regulated entities, for seeing centralized entities, etc. But I would say that on-chain is an inevitable part of any trading right now for any institution, and we think that the prime broker of the future must be able to operate like in the same way they operate on centralized exchanges, to operate on traditional finance exchanges and on-chain.
Awesome. Thank you very much, Alexander. Let's continue with Genevieve.
Thanks, Max and the P2P team. Lovely to be here. My name is Genevieve, and I handle the liquidity provider network at Talos. what the liquidity provider network really means is the entire suite of the liquidity venues that are connected on Talos. And Talos is known to be the largest and remains to be the largest provider of institutional grade digital trading asset infrastructure in the world. And we really plan to unify, the end-to-end full investment lifecycle from the OEMS, PMS, and also recently with data. Anecdotally, Talos really believes, and also personally, I do, coming from traditional finance before, is that all assets will become digital assets. And where that form takes into, whether that's a tokenized asset or a perp, say on Hyperliquid, we are extremely bullish on that proposition. We continue to support the growth of that space.
Awesome. I think we are all bullish on all assets being on chain. Thank you, Genevieve. And the last but not the least, Kyle, please.
Hey, thanks, Max. My name is Kyle. I lead capital markets and investor relations at Zama. Zama is a company that is building infrastructure and applications to make on-chain finance both confidential and compliant. We started primarily as a cryptography research organization focused on an underlying technology called fully homomorphic encryption, or FHE for short. And we kind of found our beachhead market, our product market fit in crypto, as it were. We have a general purpose protocol that bolts on to existing public chains like Ethereum and Solana that upgrades them with privacy. And on top of that, we're building a suite of financial products that enables asset managers, traders, anybody with a portfolio of on-chain assets to shield those assets and then earn yield on those assets or trade those assets. So for example, we recently launched a vault product with Stakehouse on Morpho, where you can deposit shielded USDC and earn yield on it. And next month, we're launching an RFQ OTC style product where you can swap confidential assets confidentially without revealing size or direction. So yeah, excited to be here. Excited to be on the panel with all you guys today.
Sure. Yeah. So privacy definitely was on the radars within DeFi space for like already quite a while. Really excited to have you here and discuss this in more details. All right. So let's probably continue to our first section. That would be the on-chain trading landscape. Who is actually trading, at what scale, who is still on the sidelines? And the first question would be to Duncan. If you could walk us through what 21 Shares actually sees when institutional demand turns into on-chain execution rather than just ETP exposure. And where does most of the kind of passive capital stall?
Sure. I might say, like, I wouldn't use the term stall. I think it just finds another way of kind of getting onto into DeFi. So obviously the point of, let's say, ETPs was to bridge the gap between traditional finance and DeFi and crypto. And it just allows institutions to play in that space without touching it directly. And it kind of they do their job, but that doesn't mean that we don't have trading on chain. Of course, we just work through intermediaries. So we have market makers, authorized participants, liquidity providers, right? So who are trading for the products, and that can be through centralized exchanges, but more and more we also see it through decentralized exchanges as well. And I would say this is becoming more relevant as we launch more interesting products, especially something like Hyperliquid, where if you have a hype product, you want the most liquidity, you're going to also trade outside of centralized exchanges, right? So, and that's just on the ETP side. And then as you get into more sophisticated offerings, structured products, hedge funds, I think the gap is kind of closing between those institutions and on-chain trading. It's just that everything goes through intermediaries.
Got it. What would you say is the number one pushback from institutions on not doing things actively on chain and rather have exposure through, let's say, ETPs?
Well, it's the age-old kind of regulation or risk committees and compliance at their firms normally, right? Like, I mean, I spent 17 years at a traditional asset manager before moving to 21 Shares. So I know very well what it's like to have those conversations with board members and risk committees, etc. So I think there's some of that. But I also think there's probably in some cases, a bit of a technological or skills gap as well, because it's not the easiest thing to trade on chain, even if you're an experienced TradFi trader. So I think there is that kind of skills gap and probably an infrastructure gap at a lot of the firms. But it's getting there. I mean, the journey that our clients have been on, from early institutional clients that we've had, who are now, let's say they started as Bitcoin clients and now they've moved to like layer 2s to dApps. They now want yield, then they want DeFi yield. It's definitely getting there.
Okay, got it. So it's kind of getting wider and broader. Okay, cool. So the next question I want to ask to Genevieve. So Talos sits across a lot of institutional trading flow. In your experience, what can you share about sorry, interest in on-chain trading for like within this institutional order flow, and what's holding the rest back?
Absolutely. Alluding to Duncan's previous comment, the institutional interest is definitely ramping up. Of course, this is contingent on liquidity and depth that we're seeing on a large scale. The on-chain settlement piece really depends on the execution venue. We still see really a majority of institutional flow flowing through centralized venues, OTC desks, ETF. ETF assets as well. And I would say a crucial point that would be holding the rest of on-chain trading back is not only on settlement, but also on infrastructure. On settlement, we see that with the cash side of the trade, it hasn't really caught up with the speed of the asset side. So tokenized assets and many say vanilla crypto assets can move in literally milliseconds. But the settlement piece is often the more complicated part of the trade that cannot really move with that level of speed or programmability, either due to, say, banking and compliance reasons, or by a factor of the current settlement from, I'd say, structure. And so a lot of flow defaults to venues where that mismatch doesn't really matter. In terms of infrastructure, we still see that every chain and every venue almost speaks like a different technical language, different APIs, token standards. So many institutions do also have I'd say, difficulty with doing bespoke integration work instead of just plugging and playing into one workflow. And this is where Talos seeks to bridge the gap to some extent, especially with DeFi trading. But we do see a lot more interest, and that's going to be ramping up as we see, hopefully in this market cycle, if I could call it that.
For sure. And would you say that kind of the fear of like unknown risks and complexity could contribute to this kind of pushback and then desire to act through centralized venues?
Absolutely. Not only knowledge and understanding of underlying DeFi protocols, but of course, the ongoing hacks really do not help one bit. So that's definitely adding to that level of concern and resistance that we see.
For sure. Thank you for sharing. And then to wrap up this section, I probably would like to ask a question to all of you guys. In your like news feed or in your like direct experience, what do you think has changed over the last 12 months? So where we were last summer and where we are this summer in terms of trading infrastructure and institutional adoption of on-chain trading. Anybody wants to jump in?
I mean, I can jump in on like the institutional side. One of the big things I noticed is just, and it surprised me, is how quickly things are accelerating on tokenization and RWAs. I mean, I was kind of like I spent years working on that with not that much to show for it, to be honest with you, because it was I could argue it was early, but it just felt there were a lot of gaps. I think Genevieve talked about some of them, and I think also like being able to reach the end investor was a big gap as well. But in the last 12 months, it seems to have completely ramped up. I'm not saying that discussions on like stable coins and things like that have gone away, but I feel like RWA and tokenization has ramped up, and I think I would probably put that down a bit to Robinhood. So I think Robinhood's had a big impact, and probably also say like Hyperliquid being a bit of a stick to push the incumbents along as well. I mean, you have things like X stocks in different places, but it's, for me, that's been one of the big sea changes.
Okay, sure. Thanks for sharing.
Yeah, I would say definitely that RWA trading is the key thing definitely this year compared to to the year before. I mean, it's good and bad for two reasons, because I would say that there is so much nothing happening in most of the crypto assets. Volumes are super low, open interest is extremely low, etc., etc. While Hyperliquid with this RWA view has shown that the power of technology and this 24/7 Financial Times writing write-ups about Hyperliquid, oil futures being the price discovery venue for during the oil conflict. And we actually see that our clients who used to be DeFi native found themselves arbitraging stocks. So they're actually becoming just a ordinary, not ordinary, but like a market neutral TradeFi fund, which has half of the exposure in traditional brokerage accounts, and yeah, but I would say that it kind of looks like we will get back to the old school crypto based arbitrage, especially considering what happened over the past 3-4 days. But yeah, I would say that big institutions coming to crypto and on chain is a huge thing, and as Duncan said, related to Robinhood. And soon, I think we won't see the difference between like TradeFi, CeFi, etc. It will be just one big system.
Yeah, I was talking to a market maker last week, and he called it the perpification of everything. I think that's been kind of the trend for the past several months. Hyperliquid is obviously a big player there, and this is less structural, but I would imagine some of the policy work, Genius Act, Clarity, bringing in a little bit of regulatory certainty is helping provide some tailwinds on the institutional side. We've been talking, and Duncan, you mentioned this, but we've been talking about institutions coming on chain for feels like a decade, and I don't know if it has to do with the regulatory climate or just the maturity of the industry, but it does feel like there's a real momentum in that direction.
Sure. Genevieve, want to add something, or?
All assets are becoming digital assets, and perpification. I think, as with, I do think there was interest for a while with TradFi perps, but of course, with where the market's going, I think traders are fickle altogether, but it's institutional traders are similarly the same. Flow goes to where it's the most sexy and profitable, ultimately.
Yeah. So yeah, to be fair, last 12 months were not the best 12 months in digital assets, like capital markets wise. But yeah, given the fact that in absolute terms on the volumes we're probably lower than we were 12 months ago, the relative DEX to CX ratio is all-time high, to the best of my understanding. So yeah, excited about trading moving on chain at large scale. So having that said, let's probably tap into the problems and into the challenges when it comes to infrastructure and data for trading on chain. So what kind of infrastructure and data needs to be delivered and where the current pipelines fall short. And question is to Genevieve. Talos plugs into a lot of Venus's data and execution layers. Could you give us one specific example of where on-chain data has genuinely caught up to centralized venues, and one where it clearly hasn't?
Absolutely. On the part of exactly who has caught up, definitely the winner by far would be Hyperliquid. We do see that the Hyperliquid on-chain central limit order book as a DEX has really been reaching the scale of many centralized exchanges, and it's by far one of the largest by perp volume across venues. And more interestingly, it's also one of the largest venues for real world asset perps activity, which we do see quite a lot more interest in. In terms of where we see another part of that data infrastructure, we also see stablecoin transfer volumes on different chains. And while most of those transfer volumes are really driven by DeFi liquidity movement, exchange flows, this is also moving more in that direction rather than more, user and B2B payments. So we do see those trends continuing in the space. As for where we see where the data hasn't really caught up is really more specifically on the topic of consolidated depth. On a centralized venue, you usually get a one order book, one tape, on chain. That same liquidity is really not an equivalent of a consolidated tape on a centralized exchange. Great reliability. So, proving best execution on chain is slightly more complicated, although not impossible. So we do see that consolidation on that front. We do hope that we can continue to see venues like Hyperliquid to pave the way for that level of quality, I have to say.
Sure, thanks for sharing. I just want to quickly add to this that, absolutely excited about Hyperliquid traction and what they brought to the market. At the same time, being in DeFi for quite a while, I remember like this IMMs where a lot of actual order flow was going through not even long tail assets, but rather the majors, and probably that's still the case. And it's interesting to me because in IMMs you cannot do passive price discovery, right? So every price change actually happens with a trade. So that means somebody loses value. Like order books on chain have been a thing for a while, and but always the pitfall was that the spreads were too high, right? And with Hyperliquid, this was fixed. There were like DYDX before that and some other projects as well, but Hyperliquid really brought this to another level. Thanks for sharing, Genevieve. My next question would be to Kyle. So Zama works at the intersection of privacy and on-chain infrastructure, clearly. Could you share the problem encrypted computation solves for a customer?
Yeah, sure. So, I think many of us would agree that the original sin of crypto was that public verifiability required public data, and historically this wasn't a problem in the early days. But as more and more institutions are moving on chain, privacy has become somewhat of a prerequisite. So a lot of projects have tried to solve this, right? You have private chains, but the trade-off there is you lose decentralization. You have things like ZK tokens and mixers, and you lose composability. You, in some cases, lose compliance. So our approach is a little bit different, where you don't have to make a trade-off between confidentiality and compliance. And that's the beauty of FHE, which is that you can run compute over encrypted data. So you can have the public data on chain that remains encrypted, but you have public verifiability, so you don't lose kind of the core principle of a blockchain.
Wow.
So when we're talking to people that are managing on-chain portfolios, they're running into all sorts of problems when they're engaging in DeFi. So like if you want to rebalance your treasury, you're indicating size and direction and timing on chain. That's not ideal if you're a portfolio manager. If you're taking leverage or building collateralized positions, your liquidation thresholds are public. This gets monitored. People that are trading in size, for example, don't want to move markets, move price. And so there's not really a good alternative to like OTC or dark pools that is fully on chain. So we're spending more and more time trying to think about how we bring some of basically the kind of the paradigm of traditional finance and financial privacy to public blockchains.
So would it be correct to say that the primary financial outcome of using your product would be that your customer is basically fighting MEV extraction? Yeah,
I mean, MEV is I think is one good example there. Yeah, I mean, you don't want to be front run, you don't want to be copy traded. That's low hanging fruit. Cool. Yeah, and actually, my next question to you was about the compliance, but you already answered. Like, if you can really compute whatever proofs or whatever you need for compliance based on public encrypted data, yeah, that's pretty cool. Yeah, we also have we call it programmable compliance. So you can actually delegate decryption rights to third parties, and app developers can also bake in various compliance rules into the applications they're developing. So we're not really building like an end-to-end privacy or encryption solution. We're inputting privacy where it matters, and generally speaking, that means when something settles on chain, you don't want to telegraph your balance, your trading strategies and history and counterparties. But for an auditor or a regulator or a partner, you might want to delegate decryption rights, for compliance purposes. So.
Mm-hmm. And I was also always interested for the privacy solutions. Does privacy come at the cost of something? For example, at the cost of latency or at the cost of like transaction costs or anything like this?
Yeah, so historically it did. I mean, FHE famously, the reason that it wasn't solved for a long time is that it was a really tough nut to crack. We spent several years. We have 37 PhDs on our team. Our co-founder is the co-inventor of FHE, has been working on this problem since the 90s. So the original thesis for the company was, let's hire a bunch of smart people and make FHE better, faster, cheaper, open source, and usable, and then see where the market takes us. And we had a couple of open source libraries, but the one that got the most demand was for building confidential smart contracts on EVM. And so we kind of built and rotated the company around that specific go-to-market. Historically, yeah, FHE has some computational overhead. It has some latency. We also have a hardware team here that's worked tirelessly to improve performance. We have a custom FPGA that we worked on, and actually our GPU team got us to about 1,000 transactions per second on encrypted transactions and encrypted transfers. So, we're not quite at parity today with like a Solana style chain. We are way above capacity on Ethereum. But in the next couple of years, we expect to close the gap there.
Got it. Sounds really cool. Thanks for sharing. My next question would be to Alexander. So Arkis handles capital efficiency across like different venues and I guess different chains in real time. So I would assume your dependence on like data providers and overall like infrastructure like oracles and so on would be pretty high. But could you comment on how that compares, like the kind of getting data versus the settlement mechanics? Which one is more important to you? And how do you go around kind of solving these problems on your side?
Yeah, absolutely. I would say that this is exactly the reason why, when you start working with on-chain, you actually need on-chain expertise, because the way, on-chain data providers work is slightly different to what we are used to within centralized finance. And probably like this is what, for example, Hyperliquid did fantastic, that you have this like a centralized exchange user experience, right? But overall, it is still an on-chain venue. Overall, we aggregate lots of data, of course, inside of our system, but our margin engine is still off-chain. So it's we have this pretty interesting twisted mechanics that people who are used to work with oracles, they have on-chain actors reading off-chain data overall. Right? This is exactly what oracles and Chainlink solved for, right? How to pass information from off-chain world to on-chain smart contracts. We actually have the other way around, because we use on-chain oracles like Chainlink, Peace, Redstone, etc. But we must pass them to off-chain margin
I
engine.
see.
But I would say that some people ask us, like in terms of latency, our margin engine calculates the value of positions every 30 seconds. So I mean, we are fine with with a 1 or 2 second latency. It's not that like we control for some crazy HFT execution. But I would say the data reliability is a key thing here, and having multiple backstop providers, this is what is important. And for this exact reason, I think probably we work with any well-known data provider for on-chain data in the industry for this exact reason, because we cannot rely on one RPC node, for example, only. So yeah, I would say this is what's our take on the on-chain data for margin calculation.
Okay, that makes sense. Thanks for sharing. And probably to quickly wrap up this section, question to all of you guys. If you could fix one thing about on-chain data or on-chain settlement, what would it be? If anybody wants to jump in.
Published to Bloomberg. No, selfishly, I know we all want to grow the industry together, but the more complex it is, actually, when you have alpha strategies, there's an advantage if you can figure out the problems yourself. So the more difficult it is to read, clean, extract, actually creates opportunities as well for investors. So we're okay.
Yeah, I would say that having like a decentralized experience is actually very important. I do remember myself trying to like just to replay the historical like events of some protocol or some prices of Oracle, and like back in the day, even with ChatGPT, it took me some crazy amount of time to implement this Python script, while getting daily historical data for like centralized exchanges, assets, or RWAs is very straightforward, and you have multiple data providers. So I would say that in terms of data, on-chain still has some problems to solve, and there is a room to build here.
Just like simplifying developer experience, you would say.
Yes, simplifying developer experience, and I would say especially related to any data engineering experience.
Okay, cool. Anybody else wants to jump in?
Well, we're working on encrypting all of blockchain traffic, kind of the way that we like encrypted all of internet traffic over the course of the past 10 or 15 years. So I think there's still importance of having data availability and traceability in some cases for compliance. But yeah, I tend to side with Duncan a little bit here on the data question.
Yeah, what makes me kind of smile is that 5 years ago we were like in DeFi and overall Web3 space, we were talking about blockchain infrastructure. Now we're like 5 years later still talking about blockchain infrastructure. But I think there was like a structural difference, because 5 years ago we were building infrastructure based on our kind of hypothesis or like ideas how it should become. Rather, now we're building exactly for the needs of large institutionals and for the needs of the actual mainstream adoption. So meme of the kind of Web3 infrastructure still holds, but yeah, with a slight twist. All right, so let's probably wrap up the second section here and move on to the MEV and the execution quality. We briefly touched it before, but yeah, this is where I think blockchain and on-chain trading differs a lot from traditional ones. I mean, we can argue that in the traditional markets there is MEV as well, being instructed with all this ultra HFTs and so on. But in the blockchain space, it takes probably even further scale because of the discrete time and the discrete nature of the blockchains. So my first question probably would be to Alexander. So where does MEV actually show up in the kind of cross-venue trades Arkis handles? And basically, what is your MEV position or MEV kind of yeah, like what's your opinion on MEV building Arkis? Let me put it this way.
Yeah, I would say that MEV is a curse. I
Or a
would say
blessing.
or a blessing. I mean, like it's blessing for the MEV bots, and the curse, yeah, for anyone who is building. So, I mean, I would say the good and the bad thing that, on the one hand, we are like CeFi, DeFi, TradeFi, prime broker, but the great thing, and this is actually what our lenders like about us, is that all our loans origination and repayments is done in an on-chain manner. So like we're crypto native, meaning that like every loan has on-chain trace, etc., etc. But at the same time, when you repay the loan and there's all this like integrated like interaction with on-chain world is now subject to MEV bots and MEV extraction. So for this exact reason, adding any new feature that would be off-chain will be super fast, while when it's on-chain, you must go through smart contract audits. So there is a cost for this. I would not say that MEV like puts lots of issues for us in terms of like cross-chain trading, but definitely everything related to sandwich attacks and any swaps is a big is a big issue. I would say that if you were not sandwiched, it means that you're not long enough in DeFi, and I think everyone remembered the first sandwich attack. So we also remember, it was like a small attack, but on a swap. I would say that overall, of course, the slippage tolerance is an important part if you make any on-chain swap. But I would say that mostly the MEV issue which we face is related to our own smart contracts and anything related to capital movement and extraction. This is where we must constantly defend our protocol, and yeah. So this is most of the time we try to protect ourselves.
Got it. Thanks, Alexander. Thanks for sharing. I also wanted to ask Duncan, institutions you work with, are they even aware of the thing called MEV? Like when they thinking about going on chain, do they even have do they even ask you questions about how MEV and so on?
Yeah, I think it's like maybe a misconception that like institutional investors don't understand this world. A lot of them just are not. They're just restricted from operating in it, and that's why they come to us. So half of our clients, I think probably, I think something like half of our assets are hedge funds, prop desks, group, market makers, and so they understand very well this.
I would guess.
And of course, like wealth managers, etc. They're not as familiar, but I think you probably need to distinguish between like predatory MEV and like beneficial MEV, and it also helps with price discovery. So it keeps spreads tight, which is good for the ETPs as well.
That makes sense. So yeah, I know that MEV is probably the whole it's the entire rabbit hole to discuss. But basically, a question to all of you guys: if you could share your thoughts, how would you like, and probably what's the actual practical down to earth way? What would happen with MEV within the next, let's say, five years? If you could make any prediction, or if you have any desires of how you'd want the MEV situation to play out.
I mean, if everything works in our favor, it'll go away.
Okay. Would it? Yeah, if everything is private, then yeah, there is no MEV for sure. I think. Though those who execute transactions, they still need to know what kind of transactions they execute, right? If the transaction goes against certain market maker, there is still somebody who has either the first look or the last look on the transaction which is being executed. So probably it's not like the public MEV where everybody can basically see and try to and compete on extracting that. But I mean, I might be wrong. Please correct me if you think I'm wrong. But yeah, what I'm trying to say is I would argue here, because MEV is, in my perspective, is somewhat inevitable. Privacy definitely adds a lot to it, but yeah. Any guys' thoughts on the MEV overall?
I mean, I'm definitely with Kyle that we would like it to become obsolete. Definitely, privacy is what institutions like actually need. Like on the one hand, there are some good things about blockchain, etc. But you can always like see that funds constantly they don't like when someone says, I don't know, Wintermute or Fasanara Capital or Abraxas Capital opened a huge position here and there, and I mean, they kind of accept this, but I can definitely tell you that they don't like this. This is the last thing they want to show, because eventually, when you operate in a extremely competitive market, the last thing you want to do is that everyone watching your wallet. And I can tell you that all those funds, they watch each other's wallets. They do this like day and night. It's not that they maybe steal trades. Sometimes they do, but mostly kind of like taking a look what's going on with you, like within your neighbor's garden, but which creates this interesting dynamics. So, but the question is whether we can actually get rid of MEV. So or maybe we just need to accept it as something which is part of the technology which we use, because there are so many good things about blockchain, right, compared to traditional finance, etc. So maybe we just need to accept it.
There was one particular advancement on the MEV, which I personally like. Like, I'm no expert in MEV markets, but basically, if you open like a public access to MEV plus transaction lending, then eventually the game theory kind of puts itself in a position where all this, or like most of the MEV, is actually being kicked back to the user. So an example would be like auction-based system, right? So if you submit your transaction and then solvers try to compete for the best execution, then, and if this transaction contains, let's say, $10 of MEV, then the solvers would compete and would try to outbid each other, right? Probably up to, I don't know, like $9.90, and then have only the 10 cents of the margin keeping for themselves, and then kicking this back through this transaction supply chain. Eventually, I would like it to be back to the original user.
I mean, I think we need to remember that this is as like free a market as can exist, right? Like this is, and so we almost, instead of saying we would like it to be like this in the future, like I think we all have to sort of adapt over time as the market changes, and so like if Zama is play out the way that Zama thinks, then we'll all have to adapt to that as well. So I almost wouldn't want kind of us to say, okay, this is the way everything should be. We should see how things play out over time.
Yeah, for sure. Genevieve, I wonder if your customer, like, what do your customers think about MEV? Are they on the side of being exposed, or are they the ones who actually benefit from it? And yeah, basically how it works with your customers and the MEV.
Really depends on the customer profile, as you see, but we do see that the MEV does also, it's possible that it might follow also the exchange fee trajectory. So there are some clients that could be relatively more insulated on the MEV front, but there are some clients that also take a position more, I'd say, opportunistically on that front. But it's hopefully something we can see converge and ideally disappear, if not all completely. But with new infrastructure comes new chains and new rollups, and that really has to get the entire I'd say industry also going, and hopefully we get to that point where we almost of relative maturity, I have to say.
Yeah. All right. Yeah. Thanks for sharing. Another good example of like MEV fighting, which just came to my mind, is Hyperliquid, which we mentioned a couple of times already. So I think they did a great job at fighting MEV. So with contrast to other chains, they distribute their node software as binary codes. You cannot kind of alter that as on Ethereum or on Solana for like first, and then it's centralized transaction submission. So basically, there is no way for you to do MEV on Hyperliquid. And I think that is one of the reasons why the platform, why this exchange became so popular, because it is kind of very retail friendly, if you let me. And you you won't be sandwiched as aggressively as you would be on Solana trading meme coins or or on Ethereum. All right, then yeah, we can probably wrap up the MEV section if there are no other remarks. And yeah, probably let's chat on what closes the gap between on-chain venues and the centralized trading infrastructure. A question to Duncan. 21 Shares has to clear institutional and regulatory bars before a product goes to market. What's the one gap in on-chain infrastructure still holding back the next wave of institutional products in this perspective?
I mean, I actually think the regulation's pretty good. Like, of course, different regulators are moving at a different pace. So if we take it country by country or regulator by regulator, it definitely varies. In Europe, we have great flexibility in what we can do. I'd say the US has ways of working that you can work with them. It can cost you a lot more money and take you more time, but you can get there. And then there's some other markets that are a bit further behind for regulated crypto products. So Asia, more or less across the board, is more of a challenge today. But we know that like South Korea, Japan, it's on the roadmap. I would say, like, ETPs aside, when you move towards our like active and alpha generative portfolios, the biggest infrastructure gap for me is that risk management tools, like real, so like stuff that we're used to in traditional finance, like that, the equivalents. I think there's amazing, like on portfolio management, there are already amazing tools, and we're a very happy Talos client. But I think on risk management, still not seen like top drawer kind of like solutions there, which means that you end up having to build yourself a lot of the time. So, which, similar to the data question, I guess that also creates can give you an edge, but it takes longer and it's more costly.
When you say risk management, what do you mean exactly? Do you mind just going a bit deeper?
Yeah. So I mean, if I run a crypto portfolio, I want to have live risk analytics on my portfolio any point in time. I want to be able to backtest different strategies, stress them in different scenarios. I don't think crypto's at the point where we are looking at things like traditional factors in the way that you would do, let's say, in an equity portfolio. But it will get there eventually using fundamentals. So most of it is technical, statistical. And then, like I might want to run a portfolio of SMAs. And so, again, I want to look at individual SMA, so the separately managed account on a standalone basis, the portfolio overall, and then how the risk might change as I make different allocations to those SMAs. I've not seen a complete software yet in that space.
Okay, yeah, that makes sense. Thanks for sharing. I want to ask Kyle. A couple of years ago, confidentiality and compliance were the standard objections to on-chain trading. Is it still true today?
Yeah, I mean, it's still a hot topic. I mean, I think we're working on the confidentiality side, so I think we by and large have solved it, assuming we can drive adoption. I can talk about that a little bit more. Compliance also, we have the tooling to make that work, and then there's a kind of a broader kind of regulatory question. But these are topics that come up with all of our prospective and existing institutional clients, and I don't think that will change. I think that's going to be a hot topic for the next couple of years. But I don't see it so much as an obstacle anymore, and more as a part of the kind of the solution engineering that we have to do when discussing with institutions that want to move on chain. I think as it pertains to privacy and confidentiality, for us, the big the big next hurdle is really getting distribution, and we view two different approaches, right? We have our financial products that we're building where users now can connect a wallet and they can shield their tokens, they can send and receive them, they can deposit them into vaults, they can start trading them. But in parallel, we're working with all of the existing infrastructure that's out there, the wallet infrastructure, the self-custody solutions, the qualified custodians, the centralized exchanges, to support confidential tokens. And I think that's actually going to be a pretty major unlock, both for confidentiality and for compliance surrounding confidential tokens. The moment you can start depositing and withdrawing confidential tokens in a centralized exchange, the moment that a major regulated qualified custodian has integrated confidential token support, I think it kind of kills two birds with one stone for us.
Okay, probably somewhat the same question, but from a different angle. So if confidential transactions, they are first of all confidential, right? Which everybody likes here. And second, they protect us from MEV to a certain extent. Why don't all of us right now already do all the transactions through Zama? Why are we not?
Give me a call. Let's do it. No, well, listen, we're relatively new, right? We launched at the beginning of this year, end of last year on Ethereum mainnet. We're just in the process of launching our front-end application that gives users an entry point to shield their tokens. As you can imagine, a new token standard and a new project, there's quite a bit of ecosystem development, growth, partnerships that are required to get kind of baked into the existing infrastructure. You don't just call up Coinbase and say, hey, we have a new token standard, can you integrate it? It's like, they've got a 1,000 line items on their roadmap and competing priorities. So there's a lot of education, evangelization, policy regulation. We're really focused on developing what we call our shielded TVS. We want more and more people to shield assets into the protocol such that we have some bargaining power. We can go to the exchanges and the custodians and say, look, there's billions of dollars worth of assets sitting on Ethereum that are shielded that you can now, custody, or that you can now build yield products around, or that you can now support, deposits and withdrawals. So, I think this is going to be one of those things that's slow and incremental, and then all of a sudden it will be ubiquitous. I don't know exactly when the tipping point is, but we're spending a lot of time and energy and resources in building that ecosystem, and I'm fairly confident that in the next 12 to 18 months we can get there.
Got it. Okay. Just to make sure for me to understand this right. So it actually, in order to get confidential transactions, you actually need to migrate liquidity, right? So you need to shield or wrap your tokens, you said.
That's right. Yeah.
Okay. All right. That makes sense. So Genevieve, question to you. So what you basically, after speaking about institutional products, what's the one gap in on-chain infrastructure, in your perspective, still holding back the next wave of institutional trading adoption?
Absolutely. The first thing to really note is that institutional adoption is really not uniform. So treating it really as a singular level of conversation is often a misunderstanding or a mistake. Some firms that we speak to are evaluating technology, at a tech level or a management level. Some have full board conviction, but they're just waiting for a POC or a specific custody solution. Part of this unevenness that we see is really structural. We, as Alexander also alluded to, digital assets have been the rare asset class where retail and tech got here first before institutions arriving pretty a while after. So we do see firms that kind of are retrofitting existing trading stacks onto infrastructure that really was not built for digital assets. And this really takes an extensive amount of different institutions looking at bespoke technology solutions or outsourcing that to firms like us. But the fundamental is that firms are really looking at two main things: best execution and also the same level of counterparty risk discipline that traditional finance already runs on. And that's really what we do try to bring and enhance, at least when institutions are looking at either on an early or an even more advanced stage of trading on chain, so to speak.
And when you say best execution, what does this actually mean? Like, which execution is considered best? What is important there?
Best execution would be a term that would be, I'd say, more broadly for a trader to define. But of course, based on market conditions and based on a aggregation of, say, the venues, what the best execution with the lowest amount of latency and lowest amount of, I'd say, market risk, so to speak. So in that way, the better parts, the better, to put it very simplistically.
Okay, right, that makes sense. Cool. And let's probably do the closing round. So we discussed on this call basically the data, the MEV, and what institutions want. But I also wonder, what is your like, for each of you guys, what is your most controversial take on infrastructure, or blockchain infrastructure in general, and probably trading related in particular? The one you had an argue with your friend or with your colleague about, like, what's the most controversial one you believe in? If anybody wants to jump in.
I don't know how controversial it is, and obviously we're talking around book here, but like we're of the belief that in the next 4 years, 95% of blockchain traffic will be encrypted by Zama.
Bullish. That sounds bullish. Okay, interesting.
I guess also this part is not that controversial, I guess, but people not too many people talk about it. But we spent a lot of time talking about hyperliquid, amazing for sure, perps trading, etc. I actually think the way that's disrupting the incumbent kind of venues, the vaults part will also disrupt wealth and asset management, which is a operationally like super burdensome kind of thing. And so the vaults can really basically it's almost like creating managed accounts or new commingled funds. But maybe the controversial part is, I think there's an argument to be made that because investors are allocating through smart contracts, that potentially it's not kind of actually like you're not managing their money, and you can rely on the technology. But that's the part that I probably debate with people the most, especially our lawyers.
Okay. Are you talking about the vaults and the kind of vaults things? Okay.
Yeah. So the argument would be that you're not running if you're a curator, you're not managing a collective investment scheme, because you're deciding the positions, but people are allocating and a smart contract is executing. Now, like I realize already Hester Peirce has come out and kind of killed that a bit, but that was my original kind of thesis.
Okay, yeah, that makes sense. Yeah, like created vaults for sure is something we see getting more and more adoption with different risk appetites and everything.
I actually agree with I really like I would actually use this the curated vault thing, and I would say that everyone says that vaults are the new form of asset management. I would say the two things here, that I think such huge vault adoption on the one hand shows us how asset management industry is inefficient in the way it is done right now, on the one hand. On the other hand, we have already seen multiple results of pulling like hundreds of millions into some unregulated vaults, and all of the things which like regulated fund managers would be in jail for, people are doing within those vaults. But I would say definitely the user experience of vaults is fantastic. It is actually great. But we see that now that like when these vault curators start thinking, oh, we want to do traditional finance arbitrage inside of our vault, and when they start onboarding, the first thing they've been asked, like, proof of funds. Where did you get this 30 million from? And you say, like, we can send you the 3,000 deposit addresses, which are anonymous, if that's all right. And the TradeFi brokers say, like, guys, of course it's not, because I know we don't know, like, if this address is a North Korean hacker or some sanctioned body. So I think that it is a very interesting topic. Everyone debates about, and creating a legal framework which would support this is a very interesting thing to be solved. And I'm really interested how it will be solved in the future.
Okay, thanks for sharing. Alexander, do you have your own controversial statement?
I would say, eventually what people want kind of works, meaning that, a good example is Hyperliquid, that like Hyperliquid is completely, let's be honest, non-KYC exchange. You can pull in 500 million into Hyperliquid and open a position. The thing is that when they grow, they actually see that without creating a proper legal framework, they cannot, touch US investors, etc., etc. So they try to find a common ground, and I think they will. And we already see, like this pattern rising. So I would say that what people want still would, would appeal to the regulator, and the regulator would do an effort to find a common ground. This is what happened to crypto. We remember what was Bitcoin in 2017. People were just saying, like, it's nothing. Now we can see ETPs, ETFs, etc. So I think vaults, like the asset management, will actually change in the direction of vaults, and there will be some sort of middle ground where the user experience of vault management will be available to users with a compliant framework behind it.
I would probably agree with this, to be honest.
My take really is put quite simply that, like, crypto in itself is really not the destination. It's almost like a proving ground where fragmented liquidity, 24/7 markets, and custody really got forced into the open, and it really, had to be solved out of necessity. And some of my friends who are also still in traditional finance are like, you guys are making all of us work 24/7 now, which is pretty much it. And I was like, you know what? That's how it has to be. Like, no apologies there. So I really think the real opportunity is when we are seeing more and more players take the same infrastructure and applying it to every other asset class now going digital. And I'm really excited to see, what's in it to come for the rest of and the growth of the industry. Definitely.
Yeah, for sure. Thanks for sharing. All right, cool. I think we can probably wrap up here. I want to say thank you once again for everybody on this call: Alexander, Duncan, Genevieve, and Kyle. It was an amazing conversation. It was great to meet you and have this in-depth conversation about trading infrastructure and digital assets in broader terms. Want to remind our viewers that the recording of this webinar will be available. Please follow our socials. And I think that would be pretty much it. Thanks again, guys.
Awesome.
Thank you.
Thanks a lot, guys. Good speaking with you.
Thank you.